Well, hey there, everyone. Happy Friday, October 10th, 2025, and welcome to Chart This with Dave Keller. A little earlier kickoff today at 4:30 p.m. Eastern instead of 5 o'clock p.m. Eastern. So those of you surprised and bravely joining the live stream, I salute you and I congratulate you for hopping in here. Friday, we actually usually record the show earlier in the day and then broadcast it in the afternoon. And today just figured we'd jump right in. I was close enough to 2 p.m. I thought, you know what, let's just do it. So we're doing it. You might be watching the replay later on our YouTube channel, and I'm thankful that you are doing either right about now as we debrief on a pretty tumultuous day here for stocks. We've got some charts to talk about. I'll do a quick sort of reaction to the bright color red that you will see all over the market dashboard, that you will see on the market carpet, and on a number of charts here today. And then we'll get to some of the questions. Friday's an all mailbag episode. We've got 6 questions we've hand selected from some of you and from other viewers here in the last week or two to go through in a little more detail, touching on a number of different things. Actually, we'll talk about some ETFs, talk about some individual stocks with some interesting patterns, day trading versus trend following versus position trading, all sorts of good stuff. With that in mind, let's do a quick recap. I mean, a rough day. Obviously, the market fell off a cliff, as it were, following Trump's comments, implying an escalation of a new tariff tantrum, a renewed tariff tantrum, perhaps is what we will call it. But the market basically accelerating into the close, finishing at the lows of the day. This is one of those times, if you follow sports of any sort, it's sort of like a football game where your team is just getting crushed and you just want halftime to happen. It's like this team just needs to get off the field, reset, like nothing good is going to happen and until the end of the half. And I feel like that's what we found going into the 4 p.m. close. Like until we just stop the trading and stop the bleeding, this is just going to keep deteriorating. So saved by the bell, the S&P still down 2.7%. That closes right around 65.50. That may ring a bell of sorts for some of you because I've been mentioning many, many times on this show and elsewhere, line in the sand, 65.50, right? That's the, sort of the swing lows that we experienced in August and September. Here we are right back to that point. So, going into next week, of course, this sort of distribution really raises quite a lot of questions. And next week, of course, is going to be vital. We'll see, given the fact that this news, and this sort of headline came out, morning Eastern time on Friday. We'll see what sort of discussion and debate comes around this sort of thing over the weekend. And then Monday, of course, we were open trading. Saw a comment about the sound being on. Yeah, if you're watching it on LinkedIn, I think sometimes it's automatically muted. So somewhere on there, click the button. Of course, if you can't hear me, you can't hear me explaining that. So I guess you're in trouble. Hopefully you figure that out or watch the replay later. All right. So while the S&P down 2.7%, the NASDAQ much worse, down 3.6%. This is why, it just accelerated in the afternoon. Really just needed to close. Mid cap, small caps, everything down 2.5% plus. The VIX accelerating to the upside, right? We've talked about these red flags, right? What are the red flags you look for? VIX over 20, right? A spike in volatility. I don't know about you, but this certainly feels like a spike in volatility, right? How quickly this market, the complexion of this market changes from a low volatility, everything's great uptrend to okay, this is very different. And everyone started sort of recognizing that tariffs could be an issue again. Again, the long-term implications of this we'll have to figure out. And I'm sure this will be a discussion for many over the weekend and into next week. But that's certainly where we're left here. So just some initial assessments on what all has happened here. I'm going to save a lot of my analysis and some more deeper thoughts on this from my market misbehavior premium members. We do a weekly report every weekend where I really sort of focus on what happened in the previous week and look forward at the week to come. So there's just some initial thoughts on here. Bonds obviously accelerating. So if stocks sold off so much, where did people go? Well, they went into the bond markets because the TLT was up pretty big. Rates generally came down. 10-year point actually pushed down toward 4%, down about a full percent today. Not a full percent, a full, tenth of a percent, that is. Looking at the commodity space, gold and silver, these familiar charts, it's accelerating to the upside, continuing to work as investors looking for things that are outside of equities. You can see that crude oil prices and the rest of the energy space accelerated lower. Cryptocurrencies also feeling the pain as well as equities sold off. Bitcoin, Ethereum, most of the top 10 coins all accelerating lower. On the sector side, consumer staples, one of the more defensive sector, actually managed to finish just barely in the green today. Utilities, real estate, healthcare were 2, 3, and 4. So those are your 4 defensive sectors. At the bottom, technology, the XLK, down over 4%. Energy down almost 3%, about the same for consumer discretionary. As I'm sure you can guess, the breadth was, by definition, very bearish. You've got 86% of the New York Composite members down, 84% of the S&P, 95% of the small cap index, the S&P 600, finished lower today. This is a broad decline. Very few areas of the market were spared from this, besides gold and some other random things you'll see on the heat map here in a minute. This is one of those times, right, when everything's down. This is when little widgets like this that show you, this is showing the Dow industry groups and which ones were actually up today. There were plenty of Dow industry groups that actually finished in the green. It's mining stocks, right? Gold and copper miners, water and the utilities, tobacco companies, soft drink beverages, right? So these are all kind of staples, things we're probably going to need. And then go figure, apparel retail up about 1/3%. That's one of the groups within consumer, basically within consumer discretionary. So important to note what was actually not down today. When it feels like everything was down, which most things were, focus on the things that actually did something different. In the Mag 7 space, a lot of red here and a lot of charts that we've been speculating, talking about, will they hold support? A lot of these have been broken. And again, over the weekend, we'll be digging into these charts in a lot more detail and sharing some thoughts with our premium members about how to really, get your head around what happened going into to next week. Broadcom, the worst, down about 6% today. Still not making a new swing low, but I mean, what concerns me, like Tesla making a swing low, Amazon basically giving back all of the gains from October. Some of these are kind of holding up, but a lot of these were charts that we were looking to recover. Apple's down at 245 at the close. Pretty ugly rotation, I would say, by any stretch. The 21-day EMA now in the rear view mirror for the S&P 500. There's today's acceleration. We're closing below the 21-day EMA. If we would remain below there on Monday, that really confirms a deterioration. There's our line in the sand around 65.50. That's the swing lows from September. And that's basically right where we ended trading today. The 50-day moving average is just barely below today's close. I think all eyes on the 50-day, at least by my perspective. We hold the 50-day next week. Maybe that was it. Maybe it was a sudden overreaction to the headlines today. If it's beginning of something further, the 50-day doesn't hold, and I'm certainly going to start thinking a lot more defensively. Looking at some breadth indicators, we've been talking about how defense has been underperforming offense all week. That actually started at the end of September, and that's really accelerating this week. We're now below 50% of the S&P members above their 50-day moving average. We're almost down to 50% on the bullish percent index for the S&P 500. This is a big down day, and a lot of changes for a lot of stocks not holding key support. That's going to be the challenge going into next week. But hey, Pepsi was up. So note the things that were up, and we're not going to spend any time on the market carpet because it's bright red. But look at consumer staples, plenty of things working. Look at utilities, plenty of things working, and focus in on areas that are not going down on a bloodbath day. And that's where you can find some things that may be interesting ways to weather that storm. But technology that much in the red, that hurts big time. All right, let's continue on here and answer some questions from the mailbag. As a reminder, the mailbag is always open. Anytime we're live streaming, you can drop questions as we go. Anytime you watch the show on our YouTube channel, just put a question there as you're watching. We look at every question that comes in and hand select some of those to share here on an all mailbag episode. So let's get to it. Question number one, regarding IREN, I placed a stop loss and then another buy order below the stop loss. Right, basically sell at a price, and then if the stock reaches the chosen price lower than your stop price, it'll trigger a buy, right? So you're basically, the price is going up. I should bring up the chart. Price is going up. You're putting a stop loss of some sort, right? And when that would trigger, you're basically, you have your stop loss picked, but then you also have a buy trigger, right? So I would sell there, and then if we get down to some other thing, it would trigger a buy. Is that a good idea? And you had a longer question. I summarized it so I could fit it in a little window on the show. Is that a good idea? I mean, it depends, right? As I've probably shared before on the show, I'm not a big fan of automating trades. And that's probably just it's a preference thing. I know plenty of people that automate stop losses, right? And use some trailing stop and just have that automated. That's great. And if that works for you, you should do that. For me, I'd much rather use alerts. I like platforms alerting me, hey, something's different. You should take notice. And then I evaluate the chart. And I like, taking that piece of information and that catalyst to review the chart, looking at the conditions, and then making a decision as to what I want to do. So would I ever do what you described? I would not, which is, automating a stop and then automating an entry point, because for me, that all of a sudden takes all the best part of technical analysis off of my hands, right? Which is the fact that when you're analyzing a chart, as the picture changes, you can change your approach, right? As conditions look more encouraging or less encouraging, as momentum changes, as you see a divergence, you have a big bearish engulfing pattern like we do today on IREN or EREN or however you pronounce the stock. I'm not familiar with how to pronounce it, although it is the top ranked stock in the large cap scooter rankings on stock charts. I definitely noticed that. Big bearish engulfing pattern today. I mean, most things were down, but I mean, you're going to see a lot of kind of negative candle action Thursday into Friday. So seeing things like that, sort of sometimes may cause me to adjust things a little bit. Maybe I want a wider stop or a tighter stop based on something that I'm seeing. So I'm less of a fan of automating that. I like using alerts and then reviewing the chart and then having that analysis be the reason why I actually make a trade. So for me, automating an entry point below here, right? So I mean, what you're saying would be like, would it make sense to sell your position when we undercut the 21-day EMA and then put a buy order when we hit the 50-day and just automate that? Like, I mean, that's an approach that kind of makes sense to me, but I would much rather look at the conditions when we hit something like the 50-day moving average or some arbitrary level that you pick. Because as I often describe things, right, when things move, the context matters, right? So where's the RSI during that period? What's the volume? When I'm actually making a trade, there are other things that I evaluate besides just one price point. So, I mean, those are some of the thoughts based on what your question. I mean, is that a good idea? I mean, I think whatever helps you manage risk and get into the right opportunities is probably helpful. But for me, I think the issues I have with what you described is I don't like automating things to the point that you're unable to evaluate the context and understand the environment that we're in and think about the macro perspective versus the micro perspective. I don't like boiling all that down to sell at this point, buy at this point, and then be done. Plenty of people do that. And if you're a short-term, more of a swing trader, like that is a way of thinking. If you're a day trader, that is sort of a logical way of thinking, because things are moving so quickly. You can't just be reevaluating the entire chart every tick. You have to kind of set some order levels and then just not lose your mind. So if you're more of a day trader, I could see where that would be a way you would think of it. But for me, as more of a position trader, that scares the crap out of me. I would not do that. I think there's a subjective layer that I really value. Next question. Dividend ETFs seem to be, I like this one. Dividend ETFs seem to be struggling. I've heard one expert opine that they're a safe haven in a downturn. Another says the opposite. What do you think? I mean, these days online, if there's one opinion, I guarantee you can find someone, pitching the other side of that. That's great. It's sort of a sign of the times here. And to be honest with you, I mean, there's, even with my peers of really knowledgeable market strategists with great experiences, we often will have completely different takes on something. Depending on our toolkit and how we approach things, that very much can happen. So dividend ETFs, right. So here's what I'm going to do. So I have a couple thoughts on this, and I appreciate the question. I'm going to bring up Koyfin, which is the way that I can dig into ETFs and think about holdings. So my first comment would be generalizing all dividend ETFs is kind of dangerous, and I'll give you an example. One of the biggest kind of dividend ETFs is a VIG, which is a Vanguard Dividend Appreciation ETF. So if you see the name Vanguard Dividend Appreciation ETF, my question would be, do you think these companies pay a healthy dividend? I would assume the answer is absolutely, because they're in a dividend appreciation ETF. Let's look at the holdings of the VIG. Number one, warning sign number one, 26% of this ETF is in technology. Now, technology stocks notoriously don't pay very big dividends because their growth, right? A lot of, I mean, besides the real established ones, emerging, growing technology companies don't tend to pay a lot of dividends because they're using all of the revenues to, try to grow the business. Probably don't have a lot of earnings in some cases. But so technology makes up 26% of the ETF. Financials, which makes a little more sense, at 23%. Healthcare, some decent dividends there. But I mean, immediately I'm thinking, all right, what are all these big companies that are at the top here? So what are the top, 5 holdings? Broadcom, Microsoft, JP Morgan, Apple, and Eli Lilly. Let's look at some of these. All right. Here's Broadcom, which pays a dividend yield of about 0.7%. That is not very big. Okay. Number 2, Microsoft. I think you see where I'm going with this. Pays a dividend yield of around 0.7%. That's also pretty, kind of below average. That's below the average for the S&P 500. JP Morgan actually might be above average. It is 1.9%. Okay, decent dividend. A lot of these dividend yields look pretty low because the stock prices have rallied so much, which is totally fair. I mean, so the dividend yield on the S&P is probably like 1.2% or so, I would say. Used to be higher, but because the S&P's rallied so much and they haven't been paying a lot more dividends, the dividend yield has come down because you're getting less dividend for each dollar you pay of a stock. But my point is that most of Apple didn't have a dividend for a long time, still has a very low dividend. Eli Lilly, below average. So, all the top 5 holdings all have a lower, pretty weak dividend yield. And as we go through, you can get where I'm going with this exercise. So this is a dividend. It's dividend appreciation. And the idea of this is companies growing dividends. But I think it's a little misleading to pitch this as like a high dividend yield kind of focused fund. And it pays a lower dividend than the S&P itself. And you could actually probably see that, right? Here's VIG, dividend yield 1.5%. Here's the SPY, 1%. So it's a little bit more, but is it a big like dividend paying machine? It's not. Now, VYM is another one. This is the Vanguard high dividend yield ETF. Actually does play a pretty significant dividend, around a 2.5%, right? And so if we look at the holdings of VYM, and then we look at the holdings, all right, so this makes a little more sense. Financials, the biggest sector at 22%. Biggest holdings are Broadcom, JP Morgan, Exxon Mobil. Now we're getting into some higher dividend payer types of companies. Procter and Gamble, right? Kind of like blue chip traditional dividend payers. So my first comment there is grouping all kind of dividend ETFs together and thinking of whether they're struggling. Remember, these are actually very different. And just because it has dividend in the name doesn't necessarily mean it pays a great dividend and much better than you would get from just buying the S&P 500, which has plenty of companies that pay dividends. So I think the real essence to your question, though, is, are dividend ETFs generally good in this kind of environment? Well, you can see like the VYM, which I have up, performed pretty well in Q1, performed pretty well into the April low on a relative basis. So here's the high dividend ETF versus the S&P. But then from the April market low to where we're at today, it's been underperforming. And the reason is because the S&P and the NASDAQ have been doing well. Growthy stocks that don't tend to pay high dividends have done really, really well and much better than a lot of the value-oriented sectors. So they've done, so it's underperformed. Is this the type of ETF that you would expect to outperform if the market goes down? For sure, right? The benefit of these dividend yield ETFs is, number one, you can kind of buy a basket of stocks that, ideally pay a higher than average dividend, which means you get an income component depending on where you're at in your retirement, glide path. That can be a really important source of income. So you can just, try to live off the income component to the stocks that you own. And you can see that just from today, right? So the dividend yield ETF was down about 2%. when the S&P 500 was down about 2.7%. And that's kind of what you would see. If we would have a larger and protracted decline, you would expect that an ETF like this with more defensive holdings would probably tend to do better. And because you have that dividend component, it's going to provide some income within the overall total return structure as well. So that's my thought. And do they tend to be a safe haven? Absolutely, because the types of companies that tend to pay higher dividends tend to be lower volatility. They tend to outperform in a down market. And so, yeah, if you're concerned about the market going down, things you can do: go more defensive, buy more lower volatility, higher dividend yielding companies, buy hard assets like gold, which tend to be a good store of value, buy bonds and other things that are more income oriented. That's all part of the general idea of getting more defensive, using option strategies to more defensive option strategies, things like that. All part of the story. That's why. Hope that made sense. That was kind of a ramble answer. Sorry for that. We'll tighten things up. What are your thoughts on Oklo and a potential double top? The valuation looks extreme, with a $20 billion market cap with no revenue expected until 2027. I mean, that's not unusual for enter growth stock here. Insert whatever growthy ticker you want. They all kind of have a similar issue, which is they don't pay a decent dividend. Or not that they don't have any legitimate earnings. It's all and ridiculously high valuations because you're betting on future growth and the opportunity to go further. So what's the chart of Oklo looking? Double top. I'm guessing you're talking about just like this little bit here. You can see today, obviously it's up 6.5%, while the S&P is down today. Utilities generally, as I showed earlier, did pretty well today, as did other defensive sectors. So the stock actually did pretty well. No longer looking like much of a double top if we're able to follow through above there and continue on today's gain. So if that's what you were talking about, maybe, right? But remember, with a double top pattern, when you see something retesting resistance, what makes it really a double top is the breakdown after the second peak, right? You have to break down, right? So a chart like this, I think below 110, then it's a confirmed double top pattern, right? Where we hit resistance, and then we rotate lower. And that breakdown after the second peak is what confirms it as a double top pattern. If we break above that second peak, or if the second peak really doesn't, hold and we push higher, then it's no longer a double top. And that appears to be what's happening right now with Oklo. But again, if you're avoiding stocks with no great earnings potential, you've missed out on probably the best names in 2025, including Oklo, which has had an incredible run year to date, but certainly off of the April market low. That's been the story of the markets here since April. And at some point, the music stops. Is today the end of the music? I don't know if I'm able to declare that just yet. But today's pullback, I think, for a lot of investors, kind of a wake-up call that the markets can indeed go down. This is the biggest down day we've had in forever, probably since the April low would be my guess. But we'll see. All right, we'll continue on with some questions here in a moment. I do want to take a moment to thank one of our longtime partners, Koyfin. Koyfin is a market data platform that I use all the time. We showed it earlier, looking at the holdings of some dividend ETFs. It's one of my favorite ways. I use that every day for that sort of analysis, for digging into ETF holdings, for thinking about when you buy an ETF, what exposure you're getting, how stocks relate to that. There's a question we're going to get to in a little bit about short interest, and we're going to bring that platform up as well. Great data. It was really designed to provide the tools and techniques that I used on Bloomberg, which is a ridiculously expensive platform. As an institutional investor, as an individual investor, you probably don't want to be paying thousands of dollars a month for a Bloomberg terminal. Koyfin is really designed more for individual investors and financial advisors. And if you're an advisor watching, check out some of their report writing tools, some of the ways you can use charts and visualizations within the platform to enrich your conversation with your clients. You can get more information about Koyfin at marketmisbehavior.com/Koyfin, Koyfin, or scan the QR code that you see on your screen. If you use my link, you get a little better deal than if you just go to their website, and it helps me keep Market Misbehavior awesome. So please check them out, marketmisbehavior.com/Koyfin. Next question. Which one is better, day trading, position trading, or trend following? I am guilty of doing all three of these. I absolutely 100% love the humility and honesty in how you phrased your question, right? Many of us are guilty about having what I like to call mission creep, right? You kind of have an idea of what you want to be doing, but then as you actually go through the process through a trading week, all of a sudden you're kind of a day trader and you're kind of a long-term investor. You're a long-term investor until things change, and all of a sudden you're a position, you're a trend follower. All of a sudden you're a swing trader, and kind of everything in between. And that sort of inconsistent switching of approaches is probably not going to help your returns over time. That's how you can manage to lose a lot of money in a lot of different ways in a very short period of time. So I would tell you, is there a right? Is there the best option? I'm not going to tell you that. I'm going to say for you, I think the biggest challenge you need to, or the biggest question you need to answer is which one is how you want to approach the markets, right? People can make money day trading. I have rarely tried it. I've definitely not enjoyed it. I don't like the flurried ADD flickering ticks experience of watching moment to moment things. And I will tell you, the moment when I knew I did not want to be a day trader, back in the day before quant was a thing, I remember going to Chicago and debating with these prop trading firms that were literally buying office space directly next to the SIBO so that they could have a direct pipeline from the exchange into their computers. And we were debating how many times a second that the human eyeball can detect changes in a price flicker, a price data feed on an Excel spreadsheet, because they were day trading and basically, doing arbitrage between the S&P 500 stocks and the S&P 500 futures. And because computers really couldn't do that at this point in the early 2000s, it was literally a group of guys that were watching and not taking breaks to pee and just watching and flicking buy and sell back and forth. And I remember watching them like that. There is a 0% chance that I want to do anything like this with my life. And that's what kind of convinced me that that's now that's an extreme version of day trading, but that's what they were doing. They were just, 100% glued visually to the screen and trying to just get a couple points every time. And over the day, that would turn into a decent number. Some people love the joy of that. They love the more gambling aspect of that. If that's something you want to do, give it a shot. I'm not a fan of it because I find that the game is very much stacked against you as a day trader. There are computers that can do whatever you're trying to do probably a lot better. For me, swing trading makes a ton of sense. Position trading or long-term investing makes a ton of sense. So I've done both, and I kind of do a little of both. I do more position trading than anything, which is kind of looking out a month plus. But I do some swing trading. Just think about, when things are a little overextended or underextended. I saw your question earlier, and I grabbed this. This is a slide I used to show in presentations all the time. Let me bring it up for you. Okay, hold on a second. Why is that not working? Yep, I can't get it to work, so I'm just going to show it this way. This is a slide I used to show in presentations, and it's basically how you should use technical analysis on different timeframes. Your question basically hits on a couple of these timeframes. I don't really have day trading, which is kind of a very short-term time frame. But if you think about swing trading, right, looking a couple of days to a couple of weeks at most, the market tends to mean revert, which means your approach, I would argue, should be very technically oriented. There's not much value you have in fundamental analysis because a quarterly report isn't going to help you understand the short-term overextended conditions as a stock goes above and below kind of its theoretical value. That's a swing trading time frame. You should be buying low, selling high, and betting on swings. The medium-term time frame, which is where I spend most of my time, is a couple of months to a year or so. And that's the trend following time frame. That's where relative strength matters. That's where you look for stocks showing strength because you can assume that strength continues. This is where you can follow trends. This is where you're looking trend lines and long-term moving averages. And you can use some moving average, some fundamental analysis, because now you're looking at a couple earnings reports and you're looking at trends there, but it's really more about a balance between the two. And then over the very long term, this is where you get into like the business cycle or the economic cycle, where themes and sectors come in and out of play. And actually longer term, it's more of a cyclical kind of mean reverting type of pattern. The reason why I show you this slide is because I find one of the cardinal sins for traders is that their technical analysis toolkit mismatches to what they're trying to do, right? So they're trying to swing trade, but they're using like trend following tools that are not really going to help them answer their questions very well. They're trying to be a trend follower, but they're using things that I would be using more for swing trading. So for me, I would say, think about which of these areas you want to focus on in your portfolio. And could you have multiple portfolios, which is what I do? Could you have a trend following portfolio and a swing trading portfolio? That's what I do. I actually use two different brokers, so I don't confuse what I'm trying to do in one versus the other. My point is, have a plan, have a structure, stick to that consistently. Switching between them, which is what you're implying in your question, is what gets you into trouble. All right. Next question. Is it true that when the leaders like Meta and others begin to falter, it signals the smart money is selling? You actually didn't have smart money in quotes. I added those quotes myself because I would say smart money is how I would describe it. Not all institutional investors are particularly savvy at any given point. They're making mistakes too. But I think to your point, right, if the big names start to falter, does that indicate that big investors are selling? Right, probably, right? And what you have to remember is just think about the volume, right? How much, if you and I and everyone else watching the live stream went into our Robinhood account and there's, $10,000 in there a piece and we all sell our Meta, that's still not going to be a blip on the chart. But if you're at a Fidelity and you're on $100 billion fund and you start lightening up your position of Meta, even one little incremental shift is going to outweigh all of us trading in our Robinhood account. That's the reality of the scale of some of the larger fund families and larger funds that are out there, right? So big investors running large pools of capital have the opportunity to move markets very, very quickly. And they spend a lot of their time. This is what a buy-side trading desk does, is try to minimize the impact on the markets. They don't want to telegraph to other investors what they're doing. They don't want to hurt your execution by having other people try to get ahead of you. So you use dark pools and off exchange opportunities, and you break big trades into little trades, and you do all these different techniques to try to limit the impact on the market while also changing the position that you want to change. Having said that, if everyone gets nervous and everyone starts selling, big sellers, big distribution is what often causes a big name like Meta to go down. I think that, to be honest with you, when we talk about risks in this market, big investors have had to own the mega cap growth stocks, right? If you're a fund manager and your benchmark's the S&P 500, you haven't owned Nvidia and Meta and Apple and Alphabet, like, you've gotten killed, right? You've been underperforming. So at some point you have to own those names. There's a career risk in not owning those names because they're a big weight in your benchmark. So you at least have to have some in your portfolio just so you don't get hurt if they keep going up. But if and when these stocks rotate lower, and if and when all those fund managers that have bought into Meta start lightening up on their position, that's what can cause the S&P and the NASDAQ and other indexes to go down pretty quickly. And then the selling tends to fuel further selling. Having said that, with some names, don't underappreciate the value of retail investors. We saw that in sort of the meme stock phase. There are certainly there are times when a big group of retail investors have caused significant changes by taking action on a particular name. So I think that's a part of it as well. But certainly big changes on big volume, that indicates a big rotation. We're going to leave it there, folks. Those were awesome questions. I had one that I was going to get to. I'm going to save that for next time because I don't want to just blow through it and ignore the time. Apologies for the early start. If you're just joining in here, I had to get things early so I can get out of the way. Go Mariners in Game 5 against the Detroit Tigers here. Also, I'll be heading to the Sounders game, last home match of the season with my son tomorrow. So go Sounders, scarves up. For now, I would say have a fantastic weekend. Thanks for joining me today. If you're a premium member, look for our weekly flight plan over the weekend because we'll be giving a lot more detail about reaction to what happened today, how that fits into the longer-term context we've been discussing, and some of the changes we may be thinking about going into next week and beyond. If you want to learn more about our premium memberships, no problem. Go to marketmisbehavior.com/premium. Make sure you use the code YouTube for 30% off your first 12 months on any plan. Have an awesome weekend. And remember, it's always a good time to own good charts. Take care, folks.